Good evening. Welcome back to the KB1 webinar series. So far we have done conceptual framework, just to get quick revision on the things that we have discussed so far. Then we started to discuss impairment, asset impairment, LKS 36, and we started to discuss LKS 16, and part of it we have done. So then we will complete balance part of LKS 16 quickly. Today we will continue with the balance part of LKS 16, and we will start another standard, which is SLFRS 13. Very important standard and a little complex, I would say, when it's come to valuation and measurement basis. We'll try to complete SLFRS 13 as well in our best after completing this LKS 16, right? Fine. So LKS 16, if I take you all through the things that we have discussed so far relating to this, I told you scope you should remember always when it's come to each and every standard. So when I ask scope paragraph, even I can't remember, I told you I have summarized that is there in paragraph 3, para 3. So this should be there in your standard book, paragraph 3, right? Summary. So then we started to discuss initial measurements. Initial measurement. Under that, there are cost come under initial cost. Initial cost, purchasing cost, and non-refundable taxes, delivery cost, and dismantle cost, removing cost. All these elements we have discussed here. So this initial cost covered paragraph 16 and 17. Para 16 and 17. Paragraph 16 and 17. And there are two questions we have discussed relating to this initial cost recognition. All this cost they have explained clearly with the example in paragraph 17. So we have done two questions. If you can remember those two questions we discussed, just like your A-level, O-level exams, you might not be able to handle this paper. Why? Because there are some little complexity you can see. So this is the point that we have stopped last day. So with that we will continue with the balance part of it, right? Fine. So today I am planning to start not the initial cost. Since we have done it, we can start straight away with subsequent cost. Subsequent cost. Subsequent cost means, I will refer straight away the standard, right? So paragraph 17 explain these cost elements. So these cost elements are what? Cost of employment benefit, cost of site preparation, initial delivery cost, and handling cost, installation cost. All these things you can capitalize. You can see I have highlighted those things, examples. No need to keep this in your mind. Why? Straight away they are in the standard. Highlight it and insert paragraph number in your conceptual visualization. So when it's come to subsequent, so all these things come under what? Initial element of cost, under that initial cost, right? So then you have subsequent cost as well, which is there in paragraph 12 and 13, subsequent cost. So I will straight away take you through the standard and explain you, right? Fine. So when it's come to subsequent, you should understand what does that mean. Initial cost means the purchasing cost and delivery cost and dismantle cost, all these things. Once you capitalize an asset with this initial cost elements, thereafter certain period of time, you may incur some other costs as well. Once you capitalize initial with the relevant cost factors, cost elements, subsequent, let's say you today capitalize one asset with purchasing cost, non-refundable taxes, import duties, and delivery cost, dismantle cost, present value of it, you have to value it. All these things consider and you capitalize today one assets. Today is, let's say, 1st April 2018, which is very first day of this financial year, right, last financial year. After a certain period, let's say after 6 months, you will incur some other cost as well on the same assets. So then we need to think, or we need to learn, what is the treatment on that subsequent cost. Subsequent means sometimes later, right, after initial recognition, right. Once you recognize asset initially, as I explained you, there are some cost elements. Now we are trying to learn the accounting treatment over those cost elements. So all these cost elements they have explained in paragraph 12 and 13. Don't try to remember these things, right. Again and again I am repeating this statement. Don't try to remember. Why? Because this is not the exam that you should keep things in your mind. You should be able to apply your knowledge, right. I am repeating every time this statement to set your mindset to this BFR exam. Why? Because you should keep this in your mind. What it is? Exam is testing application knowledge, not your memory capacity, right. Fine. So with that, read this. All important things again I have highlighted. Same thing you can highlight in your exam, in your standard book as well. Under the recognition principles in paragraph 7, right, recognition principle explained in which paragraph? Paragraph 7. An entity does not recognize in carrying amount of property, plant and equipment the cost of day-to-day servicing of items. Underline the word day-to-day servicing of items. Let's say you purchase a machine today. So you can't use that machine without any repair and maintenance and service cost till the end of that lifetime of that machine. Let's say machine has estimated lifetime of 10 years. So once you capitalize today, at the end of 10 years, you have a residual value. You can't derive, or you might not be able to use this asset over the period of 10 years if you don't have those regular expenses. Those we identified as what? Day-to-day servicing expenses, right. Rather, these costs are recognized in the profit and loss as incurred. So then highlight this. So day-to-day expenses also you identified where? In profit and loss account, not in your balance sheet, which means you cannot capitalize this day-to-day servicing cost. You must charge to your profit and loss account. These things you have learned, but there are some complex examples I will discuss with you, right. There are some complex examples. Cost of day-to-day servicing are primarily the cost of labor and consumables. Underline the word cost of labor and consumable, and may incur the cost of small parts. Underline the word small parts. So there is a different accounting treatment if there is any big or the significant part of that machine, right, whatever the asset, not only the machines, but it's small parts. If it is not that much valuable, so then straight away you can pass to a P&L. The purpose of expenditure is often prescribed as repair and maintenance of the item of property, plant and equipment. So this day-to-day servicing cost, including cost of labor to service or to repair and maintenance this asset, it will incur labor and some other consumables. And when you do that repair and maintenance things, when you undertake that, you will replace small parts, right, small parts. That is depends on your judgment. Those things you identified as what? Repair and maintenance cost. So what is the accounting treatment of repair and maintenance? You charge to your P&L. So this we identify as what? Major replacement. Major. So I will come to that later. This is actually repair and maintenance, not the major replacement. There is no replacement. Why? Because still you are replacing what? Small parts. So this cost you identified repair and maintenance. So here paragraph 12 you have, there are 3 elements. Paragraph 12 explain what? Repair and maintenance cost. Repair and maintenance. Repair and maintenance. When you read paragraph 13, Again, they are talking about subsequent cost, right? Parts of some item of property, plant and equipment may require replacement at regular intervals. Underline the word regular intervals. You may require to replace some parts of your assets at regular intervals. For an example, furnace may require reline after specific number of hours, and aircraft interiors such as seats and other parts and replacement several times during the lifetime of airframe. So these cost may require, these examples of cost element you may replace on a regular intervals. Therefore, if you replace interior designing and everything, seats of aircraft, those are what? Regular replacement. So these are major replacement. You identify it as major replacement. Another example they have given in the standard, furnace may require reline after specific number of hours. Furnace means normally in some other countries, if the environment is much cool, so this equipment you will use to make it heat, right? Fine. So those cost elements we identify as what? Replacement cost, right? When you replace seats of aircraft, it is what then? Major replacement, right? Fine. Further read it. Item of property, plant and equipment may also be acquired to make a less frequent recurring expenses. Underline the word less frequent recurring expenses, such as replacing interior walls of a building. So underline these examples. These examples are much more important. Why? Examiner can set your question with this example. Or take non-recurring replacement. Under the recognition principle in paragraph 7, an entity recognized in the carrying amount of property, plant and equipment the cost of replacing part of such an item when that cost incurred if the recognition criteria are met. Underline the word. This kind of code you can, under the recognition criteria, an entity recognized in the carrying amount. So then major replacements, right? Major replacement you will record where? In your carrying amount. Major replacement, right? Paragraph 13 explain major replacement. Para 13 required to capitalize in your asset, right? So here major replacement. Major replacement. So what is the accounting treatment for major replacements? You capitalize in the balance sheet, right? Examples, seats in aircraft and interior walls of a big large building. All these expenses you will capitalize in your balance sheet. So that is major replacement. Paragraph 13 clearly explained that, right? Fine. So with that, read paragraph 14 as well. This explain what? Again they are talking about subsequent expenses, right? What kind of subsequent expenses? A condition of continuing to operate property, plant and equipment. When you continue your property, plant and equipment in your day-to-day operations, may perform in regular major inspection. You may require to carry out some regular major inspections. Underline the word major inspections. It's not smaller kind of inspection, but those are what? Major inspection. If you have major inspections, what is the accounting treatment? So whether do we need to charge it to P&L or balance sheet? Better than I explain that to you, we'll see what your standard has explained to you, right? For the faults regarding of whether parts of the items are replaced, when major replacement is performed, its cost is recognized in the carrying amount of property, plant and equipment. I have clearly highlighted recognized in carrying amount of that item of property, plant and equipment as a replacement if recognized criteria are satisfied, right? Fine. Read further. Any remaining carrying amount of the cost of previous inspection is derecognized. I will explain, underline the word derecognized, right. This occurs regardless of whether the cost of previous inspection was identified in the transaction in which of item was acquired or constructed. If necessary, the estimated cost of future similar inspection may be used as an indication of what the cost of existing inspection component was when the item was acquired or constructed. Now, what you should understand, major inspection if there is any. So, those major inspection you should capitalize in your carrying amount. Now, look at this board. If you look at this board, paragraph 14. Paragraph 14 explain this. So, Raj, better if you can take this screen, not the screen board, so then you can clearly see, right. So, here there are 3 paragraphs I already explained you. Paragraph 12 explain repair and maintenance, accounting treatment is charged to P&L. Very simple, right. So, major replacement, accounting treatment capitalize. Not only this, both major replacement and major inspections. Major inspections, major replacement and major inspection. For both, accounting treatment is what? Capitalize. For both, accounting treatment is what? Capitalize, right. Once you recognize P&L, repair and maintenance, these two you should be capitalized. Now, major replacement you are very much clear. Examples you have, seats of aircraft, interior walls of a building, all these things you can capitalize. What? But when it's come to major inspection, I will give you a solid example, take down that examples as well, so then you can easily understand, right. Major inspections. Now, let us say you have a machine to manufacture T-shirts. It is not a simple sewing machine, stitch garment by sitting a woman in front of that machine, forget about that machine. But there are some complex machine, let's see, let's take that example, you haven't seen maybe, but imagine it. So, that machine is capable enough to take threads of the yarn from yarn as inputs, so then output is what? Automated, you have a garment, maybe T-shirt, whatever, shirts or whatever, fully seamless products, fully automated. So, those machines may require major inspection after certain period. Now, let us say you have undertake one inspection today, 1st April 2019, not today, very first day of this financial year. According to the standards, market standard, you may require to carry out this major inspection after 5 years, after every 5 years. So, then you should carry out another inspection on 31st March 2024 after 5 years. So, then you can capitalize this, let us say 5 million. 5 million cost you incurred, rupees 5 million, right. 5 million you incurs as what? Major inspection cost. So, what is the accounting treatment of this? If you are rearranging this major inspection after 5 years, you should depreciate this over the period of what? 5 years, right? 5 years. That is what you should understand. Sometimes the useful life of this machine can be 10 years, let us say, but you need to undertake this major inspection after every 5 years. So, then you can capitalize this 5 million over the period of 5 years, not the 10 years. You can't capitalize this cost over the period of machine's useful life, but you should capitalize over the period of 5 years. Why? You have to undertake this recurring or regular major inspection after every 5 years. And standard explain another thing to you. What it is? Let us say due to some reason you decided to carry out the next inspection without waiting till 31st March 2024 at the end of 3rd financial year. Let us say 31st March 2022. So, then what is the accounting treatment? You will incur another, let's say 5 million here, 5 million. So can you depreciate previously recognized 5 million for balance 2 years as well? You have another 2 years here. Question. Standard says, if you carry out major inspection before 2024, you must de-recognize this capitalization. De-recognize. You must de-recognize. You have capitalized, but the balance 2 years amount you must de-recognize. Maybe 2 million then. So then you can capitalize 5 million on this date and depreciate over the period of next 5 years. Understand? So this is a simple example, right? Don't misunderstand. These are the complex areas, right? So somebody will think, alright, assets useful life 10 years, we can capitalize over the period of 10 years. No, nothing like that, it's wrong. Here also major replacement you can capitalize. So major replacement you have to identify, let's say you have capitalized seats of aircraft, right? Seats of aircraft. Aircraft may have useful life of let's say 10 years, but seats you have to replace over the period of every 3 years, 3-year regular interval. So then seats you can capitalize for 3 years, every 3 years you will replace it, major replacement. So then seats can be depreciated only for 3 years. So this is what the accounting treatment for subsequent cost. So these things, paragraph 13 and 14 may not, these two paragraphs may be new to you all, right? But repair and maintenance, all these things you have understand, you have identified, you have learned during A-level and O-level period, right? Fine. So now see, this nice summarization should be there in your standard book, right? Nothing new. Scope is in paragraph 2. You have to recognize asset initially according to conceptual framework also we have identified. We have recognized, we have learned initial measurements and subsequent initial recognition actually, initial measurements, you have initial cost to identify and subsequent cost as well. So accounting treatment for those two we discuss. Here what is exclude, what is include explained clearly in paragraph 17 and 18 as well, right? But 17 is much more important. Why? That has clearly mentioned the cost elements that you can consider for capitalization. Thereafter subsequent cost in these three. Now you know, right? Paragraph 12, repair and maintenance charge to P&L, major replacement, major inspection you charge to your, not charge, you capitalize in your balance sheet. That's all, right? Fine. And examples also you have. So after this subsequent measurements, then what you should do, you should have a subsequent measurement, right? This is initial measurement, initial recognition actually, then subsequent measurements. Second part of it is subsequent measurements. Subsequent measurements. So conceptual framework explain you there are 4 valuation methods to recognize cost, to measure the assets and liabilities, income and expenses after initial recognition. After initial recognition and each and every period end, you should assess the value of asset and liabilities by using the relevant guideline in the standard. So LKS 16 has given you these 2 guidelines, right? So when you measure assets, property, plant and equipment subsequent to this initial recognition, either cost model, oh, this is what you should know, right? Cost model or revaluation model. Revaluation model, right? O, very important word, O. You have option. Either you can select cost model or revaluation model, right? Cost model explain this, right? Cost model means your purchasing cost, purchase cost minus accumulated depreciation minus if there is any impairment. This is what the cost model. This is what the cost model, right? Purchasing cost minus accumulated depreciation and subject to impairment if there is any. That is cost model. Revaluation means revalued amount, sorry, fair value at the date of revaluation. We will say like that, that should be the word actually. Fair value of the revaluation date, right, fair value of that revaluation date minus accumulated depreciation subsequent to this revaluation, accumulated depreciation minus if there is any impairment thereafter, right. Here you have to consider fair value, which is explained in SLFRS 13. Today itself we will discuss it, do not worry, right, fine. So, this is the standard guideline for subsequent measurement. Now, we have to understand what are the standard reference paragraph relating to this. Why? You know, I can't remember what it is cost model guidelines and what is revaluation model guidelines, but I should know. Knowing those things, we have to refer standard to handle exam question. Now, we will see how examiner, so how his standard has explained these two. Now, go back to the standard. If you take paragraph 30 and 31, para 30 and 31, I am quickly trying to complete this standard. Why? Because this is not a new standard for you all, but little important questions can be tested, that is why, right. Important means complex question, we will do one question as well, right. An entity shall choose either cost model or revaluation model. Underline the word cost model or revaluation model. Very important word is what? O, for them to measure subsequently, right. Then what is cost model explained in paragraph 30? So, then para 30 here, cost model explained in para 30 and revaluation model explained in para 31, right. Cost model means after recognition of an asset, initial recognition they are talking about, right. When you come to initial recognition, we discuss what are the initial cost element that you can capitalize and what are the subsequent cost after initial recognition you can capitalize. That is not the subsequent measurement, that is subsequent cost, do not misunderstand. Subsequent cost and the subsequent measurement, this is subsequent measurement, right. An item of property, plant and equipment shall be carried at cost less accumulated depreciation and any impairment if there is any. Cost minus accumulated depreciation and it is subject to what? Impairment if there is any. That is cost model, right, fine. That I have explained in the board. Go to revaluation model. When we are talking about revaluation model, after recognition an asset, property, plant and equipment, whose fair value, underline the word fair value, right, fair value, here cost, but here fair value. Revaluation model means fair value can be measured reliably, shall be carried at the revalued amount, right, revalued amount, fair value at the date of revaluation less, fair value when? Fair value at the date of revaluation less any accumulated depreciation, less any accumulated depreciation and subsequent impairment loss. What is the difference? Here cost minus accumulated depreciation minus impairment, here fair value at the revalued date and any subsequent accumulated depreciation and the subsequent accumulated impairment. Underline this word specifically, fair value at the date of revaluation. Examiner can play with these dates, right? Examiner can play with these dates, therefore highlight at the date of revaluation and any subsequent accumulated depreciation and subsequent impairment loss. Highlight those two. So, that is important, right? Fine. So, then you should understand how frequently we should do this revaluation. Is it mandatory requirement? Is it optional? If it is need to do, how frequently? That is also can be tested. Important things I am only picking from the standard, right? So, the frequency of this revaluation, you have to read paragraph 34, right? The frequency of revaluation, underline the word frequency, right? Frequency of revaluation depends upon the changes in fair value of property, plant and equipment been revalued? Depends on the upon changes in the revaluation of property, plant and equipment revalued, right? We will read further to understand this properly. When fair value of revalued asset differ materially from carrying amount, underline the word materially from carrying amount. Let's say your carrying amount 100 but revalued amount 200, materially differed, right? Your carrying amount, let's say after certain period 100 but revalued amount 200, double it. So then it is materially differ from carrying amount, further revaluation is required. So then it's required further revaluation. But let's say, always understand this logically, your carrying amount is not always the market value. It cannot be, right? But there can be smaller differences. Let's say your carrying amount 100, the market value 102 or 98. Small upward or the downward. So then it is not required to do what? Regular revaluations. Understand it. If there is any significant difference, material difference, so then you must carry out what? Revaluation. Some item of property, plant and equipment experiences significant volatile changes in fair value. Some of the assets may have significant volatility when it's come to significant volatility in the market, right? Such frequent revaluations are unnecessary for the property. Such frequent revaluations are unnecessary for the item of property, plant and equipment with the insignificant changes in fair value. Instead, it may necessary to revalue of the item only every 3 years or 5 years. Instead, if may necessary to revalue the item only every 3 or 5 years. Underline the word 3 year or 5 year. Right? 3 year, 5 year. Now read further 36 as well. If an item of property, plant and equipment is revalued, very important statement. If you have revalued it, the entire class of property, plant and equipment which that asset belongs shall be revalued. Which means, now let's take this CA Sri Lanka building and we are in classroom number 2, right? Classroom number 2. We have furniture and fittings, we have this table, we have this projector and some other fixed assets. So if you decided to revalue this chairs or the furniture and fittings, you can't revalue only the items or the fixed assets in this classroom. Entire class of asset you must revalue. So then entire furniture and fittings of this Sri Lanka organization you must revalue, right? But you cannot revalue only the items belongs to what? Classroom number 3. That explained in paragraph 36, right? Frequency. Here the frequency of revaluation. Explain in paragraph 34 and 36. Para 34 and 36. Very simple diagram, right? Very simple diagrams, right? So I have developed this diagram in a different page. Why? To summarize, it's for your benefit, right? Fine. Now this is about revaluation, right? So when it's come to depreciation, third one is what? Depreciation. Now you have initially recognized, capitalized with these cost elements, then you have subsequently recognized, subsequently measured those under the cost or revaluation. Now what you have to do on a regular basis at the end of each reporting period, you have to depreciate those assets. Depreciation. Depreciations. So when you carry out your depreciation, the standard explain you this. What they have explained you, you can follow two methods, right? Paragraph 55, right? I'll take straight away to paragraph 55. I am not trying to invest much more time on this, that is why I am quickly doing these things, right, very important, but you know these things, right, fine. Go to paragraph 51. The residual, paragraph 55. Right, you have straight line method and reducing balance method, all these things are fine, you know these things, therefore I will straight away take what, the important thing. Depreciation, on the very to yesterday session, when I started to discuss this LKS 16, right, I took one example on this part, paragraph 55, right. Depreciation of asset begins when it's available for use. When it's available for use, underline the word available for use. You should start depreciation according to paragraph 55 when asset is available for use. If when asset is available for use, you can start depreciation. Underline the word when it is available for use, right, fine. Now the last part I am trying to take, how do you paragraph 6 and 51, take 51, realizable value, residual value, not the realizable value, residual value. I don't have space, therefore I will take somewhere here, right. The last part I am trying to take residual value. Residual value. So standard explain clearly residual value in paragraph 6 definition, take the definition. So you should understand first what does that mean, right, residual value. Read this. The residual value of an asset is estimated amount that an entity would currently obtain from disposal of that asset. Underline the word currently obtain disposal of the asset after deducting estimate cost of disposal if the asset already of the age and in the condition expected at the end of its useful life. So residual value means how much you can recover from that asset at the end of the useful life. So when you derive that residual value, that is the value the currently obtained from disposal assets, the value the currently obtained when you sell in the market, deducting the cost of disposal, which is explained in para 6, right, paragraph 6, para 6. And if you go to paragraph 51, they are talking about this depreciable amount and depreciation period, right. The depreciation amount of an asset shall be allocated over the systematic basis, that is fine. The residual value and useful life of the asset shall be reviewed at least at each financial year end if expectation differ from previously estimates, right. What you should understand, accounting depreciation is an estimate, useful life of the asset is estimates, right, all these things are estimates. Now you can't exactly conclude saying that this machine is available for next 5 years, at the end of the 5 year this machine value will be 0 in your books of accounts, but physically there can be value and asset can be used further. So understand that as well. Therefore, the residual value of the asset shall be reviewed at least at the each financial year end if the expectation differ from previously estimates. The changes shall be accounting for changes in accounting estimate accordance with the LKS 8, accounting policy changes and accounting estimate. So this is what accounting estimate covers under LKS 18. LKS 8 required for you to carry out residual value testing at the end of each financial year if the expectation is differ year on year, right? Fine, which is explained in paragraph 51. Para 51. Para 51, right? Right, fine. This is all about what? This is all about property, plant and equipment standard, right? Fine. Now I will take simple example from your study text, right? So here also you should understand revaluation. So once you do your revaluation, there can be upward revaluation, there can be downward revaluation. Both are possible, right? Which means when it's come to revaluation, right? When it's come to revaluation, 2014, I'll take simple example, right? So Raj, better if you can take the screen, so then I can explain the example, right? So here you have option to recognize or you to measure subsequently by using revaluation, right? Revaluation, which is explained in paragraph 31. So the problem here, let's say your initial recognition was in 1st April 2015, initial recognition, right? Initial recognition, I'll use shortcuts, initial recognition. Thereafter, you measure this by using revaluation model when it's come to 31st, let's say 31st March 2016, revaluation model you use. So then you had a revaluation gain here, right? Gain. But when it's come to end of, let's say 31st March 2018, again you have done revaluation model using. So here you have revaluation loss. So then what should be the accounting treatment for these? That we need to discuss, right? So for this I will do one example that can be exam question sometimes, right? Fine. So this is a summarization of LK 16 for your benefit. Some of the elements I haven't touched, like depreciation, very simple, you know how to handle those things. But complex areas I have taken this diagram. Within a minute I will explain, thereafter straight away we can move into discuss one exam question which is from ACC, right? Fine. So property, plant and equipment, how do you recognize property, plant and equipments? Asset recognition criteria should have been met. So what are they? It should be resource controlled by the entity as a result of past event, and it should be able to control, and economic benefit should flow to the entity, and it should be measured in a reliable way. And scope explain you what is in, what is out. Paragraph 3, refer and understand. Thereafter there are 4 learning outcomes, I would say, right? Initial measurements, subsequent measurements, initial recognition and subsequent measurement, and how do you depreciate assets, and what does that mean? Residual value. When it's come to subsequent measurement, you have revaluation model and the cost model, right? Therefore, you have talked revaluation little in detail, right? Fine. Initially, these kind of costs you can capitalize. Paragraph 18 explain you the cost that you can't capitalize, but paragraph 17 is much more important for us. That's why I took this to the summary. And subsequent cost, para 12, para 13 and para 14. Para 12 explain you repair and maintenance expenses which you need to charge to P&L. Major replacement explained in paragraph 13 which you require to capitalize. Major inspection cost also you need to capitalize in your P&L. Understand, irrespective of asset useful life, you need to capitalize this by identifying the useful life of replacement and the inspection. Let's say you asset to useful life 10 years, but it's required to carry out major inspection over the period of 5 years. So then the cost incurred for major replacement you have to capitalize over the period of and you have to depreciate over the period of 5 years. In any case, if you decided to carry out next inspection in advance, right, in advance, you must recognize, you must de-recognize the previously capitalized amount relating to that major inspection, and you can capitalize new major replacement. That you have to understand. This is about recognition. When it's come to subsequent measurement, standard allows you to either to use cost model or revaluation. Cost model means purchase cost minus accumulated depreciation minus impairment. Purchase, not the purchase cost, actually initial cost. All these cost elements can be for you to understand in simple way. I took that purchase, assuming that there are no other costs, right? When it's come to revaluation, you have to take the fair value at the date of revaluation minus any subsequent accumulated depreciation minus impairment, explained in paragraph 31, right. The frequency of this revaluation explained in paragraph 34 and 36. And revaluation, when you carry out revaluation, some years you may have revaluation gain and some years you may have revaluation loss, right, that is all. Thereafter depreciation, there are two types of depreciation, straight line methods or reducing balance method. Either reducing balance method or straight line method, you have to start depreciation assets when it is available for use. Underline the word available for use. Paragraph 51 explain clearly that, right. These are simple things that you can mislead, right, misinterpret. Why? You have not experienced learnings through what? Learnings with standard book, right. Therefore, this is much more important. Why? You have to, your lecturer is not me or your classroom lecturer from different institute, but this should be the lecturer, standard book, right. Standard book should be the lecturer for you to pass this exam, right. He will give you the relevant inputs to the questions. Depreciation fine, then residual value. Residual value explained in paragraph 4, paragraph 6 and paragraph 51, right. Residual value means the value at the end of each life of the asset. Clear? Clear? Fine. Now with this learning outcomes, we will see some past paper questions, right. Fine. Read this past paper question. Not the past paper question, actually model question, right. This is from revaluation. I told you the upward revaluation and downward revaluation, both are possible, no? Right. Read this example. So then I will explain, right. Read this. Right. A company acquired land on 1st January 2011 at a cost of 65 million. So, initial cost, acquired amount, initial cost. The land was subsequently revalued. Initially you recognize as cost, acquisition cost, may incur some different cost element, does not matter. Subsequent measurements, standard allow you to use either cost model or what? Revaluation model, both are possible. They have used what? Revaluation model, right. Subsequently revalued upward to 68 on 31st December 2004. So, when it is come to December 31st 2004, it is revalued up to 68, which is upward revaluation. At the end of 2017, as a result of fall in market value, the fair value of this land fell to 63 million. There is no depreciation for lands, but revaluations are there. The market recovered in 2019, and by the end of the end of that year, the land has fair value of 17, right. Land has fair value of 2017 when it is come to end of 2019, right. Fine. With that, you have to record each revaluation gain and loss, right. Read this till I erase this board, so then we can work on this example, right. So, these kind of questions do not expect in the exam, but I will explain this for you to understand the concept, right. So, on 1st January 2011, they have purchased this asset, rupees 65 million, right. The land was subsequently revalued for 68 million at the end of 31st December 2014, 31st December 2014. Don't worry, no depreciation. Why? It's a land. To 68 million rupees, 68 million, rupees 68 million. So then you have revaluation surplus. What is the double entry? Revaluation amount, double entry, property, plant and equipment, assets value has been increased, debit, how much? 3 million, right? Understand, revaluation gain you will not identify in your profit and loss account as a business income or other income. It should be charged to equity through what? OCI, right? Other comprehensive income credit 3 million should go to other comprehensive income, right? Very important, make a note there, right? Always revaluation gain you will recognize your other comprehensive income. It is not a normal business income. It's not realized from your normal course of business. Then 2017, at the end of 2017, right? Let's say 31st March 2000, December 2000 or March, whatever, end of 2017, right? 2017, asset value fall in the market. As a result of fall in the market, the fair value of this land reduced to rupees 63 million. Now you should understand revaluation gain or loss. Now how much the loss? Revaluation loss from 68 that has been reduced to 63, 5 million. So here gap 3 million, here the gap 5 million. Now understand, if there is any downward revaluation, right, which means revaluation loss, you must charge to not to OCI but to profit and loss account. Straight away you have to recognize profit and loss account. But standard explain you this, what that is, if there is any revaluation gain that you have identified in previous years, you have to de-recognize that, or you have to set off that, and balance only you can charge to P&L. Therefore, accounting treatment, you have credited already 3 million to OCI, debit it. OCI debit 3 million, maximum you can recover. Why? 5 million is there as a loss. So then balance you can debit to what? Profit and loss account. P&L only debit 2 million, and asset should be decreased by 5 million. So then asset credit 5 million. Very simple, right? Very simple to explain this with numbers. Understand it. Previously you have a gain, you had a gain, so then you have recovered that gain and only balance you charge to P&L, right? Fine. Now when it comes to last year, end of 2019, right? End of 2019, again you have valued this to 70 million, right? The market recovered in 2019, and by end of that financial that year, land has valued to fair value 17, right? End of 2019. End 19, this has value of rupees 70 million. Now you should understand, is there a gain or loss? Now they have valued to 70 million, which means from 63 to 70, 7 million gain. Now you have a 7 million gain. What is the accounting treatment for this 7 million? Here you had a loss of 2 million, understand it. In 2017 you had loss of 2 million. If there is any loss, you have to recover that loss, and balance only you can charge to OCI. Why? Because if there is any gain, additional gain, you should recognize in OCI, right? Fine. OCI credit, sorry, property, plant and equipment should be debited. PPE debit 7 million, and P&L should be credit. Why? Earlier you have recognized 2 million as loss, that you have to identify again back to the P&L, and OCI how much? credit 5 million. OCI 5 million. Right? Fine. Now look at this example. Very simple, right? Initially you recognize at 65 million, thereafter you revalue to 68 million, 3 million gain. Straight away you recognize where? In OCI. Right? Other comprehensive income. It is not, why? It is not generated from your normal course of business. Then at the end of 2017, they have again identified there is a drop in market, therefore this asset valued to 63 million, therefore there is a loss. Then you like initial this loss should have been recognized in P&L, but you can't do that straight away. Why? Initially earlier the previous financial year you had gain. So set off that gain and balance only you can recognize in your P&L. So OCI credit debit 3 million and balance only you can recognize in the P&L. When it's come to the next the 2019 end, again you had gain of 7 million. Straight away you can't recognize that in OCI as 7 million. Why? Last year you have recognized 2 million to the P&L as a loss. Recover that 2 million and balance only you can recognize new OCI. Now look at the total scenario. Your initial value of 65 million and right now you have 70 million, which is 5 million gain. That 5 million gain reflect in this OCI. Altogether that is there, right? 5 million, right? Fine. So this is the example. What you should understand when it's come to revaluation, I wanted to touch this point, revaluation, gain or loss can be there in summary. Gain always should recognize where in OCI, loss to the P&L, right? But if you have gain earlier recognized, when you recognize loss in this year, you have to set off it against that gain. And if you have a gain loss in previous year, and if you have a gain this year, again you have to recover that loss and balance only you can recognize in your OCI. This example explain you the upward and downward revaluation. Here you have upward revaluation and here you have downward and again you have upward, right? Upward. So this is the good example. This is a good example for us to learn revaluation. Understand that, right? Fine. Okay. With that simple question, straight away we will move into discuss very comprehensive question from ACCA, right? So all these learning outcomes captured to that question, has captured to that exam question, right? Right, read the question. Read the requirement first. Discuss the accounting treatment of the above transaction in the financial statement of kites, right? So, because of the time constraint, I will read it for you. You can read the same with me, right, and have a summary. You need to discuss. You need to discuss this question. Just you can't prove anything with numbers. You have to give some more information. Keep that also in your mind. Kite's vessel constitute of material parts of total assets. Material parts of total asset. Vessel means you know navak, right? Ekak thiyena material parts of total asset. Right, nave banda tiyenna puluwan, seats tiyenna puluwan, different things. I don't know. We'll see. The economic life of the vessel is estimated to be 30 years. That is the useful life of this vessel. But the useful life of some of the vessel is only 10 years because Kite's policy is to resell or to sell this vessel when they are 10 years old. Even they have 30 years lifetime for the assets, vessel, they are trying to sell it after 10 years. Therefore, some of the assets they have useful life of only 10 years. Kites estimated the residual value of the vessel. Have we talked about residual value? Have we discussed? Yes, we discussed residual value, right? Residual value should be the value at the end of the life period, and you have to assess at the end of each financial year, right? Kites estimated the residual value of this asset at the sale to be half of the acquisition cost. Is that correct? Kite estimated the residual value of this vessel at sale to be half of the acquisition cost, and this value was assumed to be constant during their useful life. You understand the assessment on this residual value is correct or wrong, that we have to explain. Kites argues that estimated residual value used were conservative in view of an immature market with higher degree of uncertainty. They argued saying that estimate residual value were conservative, traditional in view of the immature market with higher degree of uncertainty, right? And presented documentation which indicate some vessels were being sold for prices considerably above the carrying value, and they have proved saying their statement saying that some of the assets they have sold at higher value compared to carrying value. Broker valuation of residual value were considerably higher than those used by kites. If broker valued this vessel, their residual value were considerably higher than those valued by kite. Kite argued against broker valuation on the ground that it would be result greater volatility in the reporting. Now the fundamentals you have to understand. Broker has given you a valuation and you have done your own valuations, right? So which is more accurate? So what is your method? You have taken only 10 years. Why? Because at the end of 10 years you are trying to sell this asset, right? Therefore they are taking what? Half of the, but useful they are taking somewhere here. They can sell the cost economic life of this vessel estimate 30 years, but useful life of this vessel, some of the vessel 10 years, because Kite's policy is to sell the vessels after 10 years. Kite's estimated residual value of this to be sell half of the acquisition. Straight away they decided to take half of the value. But broker has given different valuation. Now is that correct to take half of that value at the end of 10 years? What is the basis? No basis. Just they have assumed it and taken. Totally wrong. That is what you need to discuss with examiner. Discuss. Right? Thereafter, Kites keep some of the vessel for 30 years. Out of some vessels, they are keeping till end of 30 years, and these vessels are required to undergo an engine overhaul. They need to undergo engine overhaul, major replacement or repair, that you have to understand, right? Major inspection or repair, right? Anyhow, both you can capitalize, right? In dry dock, every 10 years to restore their service potential, right? This is what? Major inspection, every 10 years, right? To restore their service potential. Hence, the reason why some of these vessels are sold. The residual value of this vessel kept for 30 years is based upon the steel value. Residual value of these assets, some of the assets they are selling at the end of 10 years. How they have arrived their residual value? By considering half of the acquisition cost. Some of the assets they will keep till the end of 30 years. Thereafter they are taking residual value of those assets based upon steel value of the vessel at the end of the economic life. Two measurement bases, two methods they have followed to decide residual value of these assets, right? සමහර assets තියාගන්නම අවුරුදු 10ක්. ඇයි අවුරුදු 10ක් තියාගන්නේ? අවුරුදු 10ට පස්සේ විකුණනවා. ඒ හින්දා යාළුවා decide කරනවා half of the asset should be the value of the residual value. සමහර assets යාළුවා තියාගන්නවා at the end of 30 years. එහෙමනම් එයාලගේ value එක මොකක්ද residual value එක steel value, right? Fine, those are the information. At the time of purchase, the service potential which be required to be restored by engine overhaul is measured based on the cost as if had been performed at the end of the purchase of the vessel. In the current period, one vessel had to have this its engine totally replaced, right? Major replacements. After only 8 years, they have replaced the engine after 8 years. I told you subsequent cost. This is not initial cost, subsequent cost, right? Major replacement, engine replacement means major replacement after only 8 years, but normally they are doing it. Normally engine lasts for 30 years, economic life overhaul every 10 years. හැම අවුරුදු 10කට පස්සේ තමයි මේක replace වෙන්න ඕනේ, but they have done little in advance. 8 years වලින් මෙයා කරනවා. එහෙනම් balance 2 එක මොකද accounting treatment එක? When they have capitalized this major replacement cost at the time of incurred, they have depreciated, they should depreciate over the period of 10 years, but they have done this replacement after 8 years, therefore balance 2 year you must what? De-recognize, right? Accordingly, one type of vessel was having its funnel replaced after 15 years, but funnel had not been depreciated separately. Funnel had not been depreciated separately. It's a major replacement. Why they have not depreciated separately? So those things you have to discuss, right? First thing, residual value. Here, can you estimate residual value by taking half of this? Totally wrong. But here they are using the vessel till the end of the useful life. Therefore, the basis is what? To take steel value, which may be correct, but this is totally wrong. And your recommendation should be, when you discuss the accounting treatment with your examiner, the broker has given you a valuation, that value should have been considered at least to value what? The scrap of this or the residual value of this vessel. That is the way you should answer to this question, right? Fine. Now I am recommending to follow these steps. Look at this answer. This is the way you should structure this answer. Use paragraph 6 and 51. Para 61 and 51 of the standard. වගේ standard book එක තියෙනවා. Standard book එකේ තියෙනවා නම් මේව කටපාඩම් කරගන්න ඕනේද නැහැ. Right? According to LKS 16 in international IAS, LKS 16, paragraph 6 define residual value definition. Paragraph 6 is for what? Definitions. Definition residual value is explained in this way: as the estimated amount which an entity would currently obtain from the disposal of asset. Currently obtain from the disposal asset. But they have considered what? Half of the cost. Is it in line with the standard definition? Totally wrong. Very simple, no? මේවා කටපාඩම් කරගන්නද නේ? Standard එකේ කියනවා currently obtained disposal would be currently obtained from the disposal asset after deducting estimated cost of disposal. But they have taken half of the asset cost. Totally wrong. Acquisition cost. If the asset were already at the age in the condition expected at the end of the useful life. Now that is straight away you have taken from paragraph 6 of the standard. Why you have to discuss now? When you discuss questions with the examiner, you have to use some reference from the standard book as well. Otherwise you can't discuss your own, right, without taking these facts from the standard. Now standard එක ගත්තට වගා තියෙනවා answer. First point. I think first point එක standard එක. එතනින් පස්සේ මොකක්ද ඔයා කරන්න යන්නේ? Take case study information. Kites calculation of residual value of the vessel with 10 years useful life is unacceptable under IAS 16 property, plant and equipment. I told you clearly you have to give your recommendation to the examiner. Unacceptable. Whatever by examiner, right? Unacceptable, right? Due to non-compliance IAS 16, right? LKS 16. Because estimating residual value based on the acquisition cost does not comply with the requirement of LKS 16. Kites should prepare a new model to determine residual value, which would be taken into account broker's valuation. I told you, rather than taking half of the value, It's better to go with what? Broker's valuation at the end of each reporting period, and which would produce zero depreciation charges when estimated residual value was higher than carrying amount. That's fine, right? Again, ICASL 16 require residual value to be reviewed at least at the end of each financial year. Paragraph 51 explain that, right? Financial year with the depreciable amount of an asset allocated to systematic basis over the useful life. LK 16 specified that the depreciable amount of an asset is determined after deducting residual value. Have they conducted this testing at the end of each year? No. That is also not compliance. As regard to vessels which are kept for whole of their economic life. Now we have talked about what? The residual, the kite's residual value estimation for 10-year-olds or 10-year-olds vessels, right? Now some of the vessels they will keep till the end of period. Now we have to give a recommendation on that. The residual value based on upon scrap value of the steel is acceptable. That is your recommendation. Can be acceptable. Why? You will keep this asset till the end of useful life. You will not sell this asset in between, right? Therefore, the vessel should be depreciated based upon the cost less scrap of steel over the 30-year period. That's fine. So, we have given the recommendation, or we have discussed the accounting treatment that they have followed for residual value estimation relating to 10 years useful life your machines as well as 30-year machine with 30 years useful life. Clearly you have given 4 points you have to explain. Then when major planned maintenance works are to be undertaken, the cost should have been capitalized. Major replacement cost or major inspections, right? Now it's a major replacement. The engine overhaul, we have major replacement. Engines you are trying to replace. The second scenario of the question, right? Second scenario. The engine overhaul will be capitalized as a new asset which will then depreciable over the period of 10 years period to be next overhaul. Why? Even vessel has 30 years useful life, engine you have to replace what? How frequently? 10 years frequent, right? After at the end of 10 years you have to replace this engine. Therefore, you have to recognize this as a separate asset and you have to depreciate over the period of 10 years, right? Fine. So then the depreciation of original capitalized amount will be typically calculated such that it had net book value if net book value of nil when overhaul is undertaken, right? Which means when it's come to next engine replacement, right? Your asset, the initial replacement cost should have been nil, right? Why? You have capitalized over the period of 10 years and at the end of 10 years that should be nil. That is should be the case. This is not the case with one vessel. That is not the case. Why? Because of the work was required earlier expected, which is 8 years. I told you. After 8 years they have to do that replacement. In this case, remaining net book value of the old engine overhaul cost should have been expensed immediately, which means you need to de-recognize. Right? Fine. Then initial curve of the component should be included major maintenance events which may likely occur over the economic life of the vessel. Sometimes it may subsequently be found that initial allocation was insufficient detail in that not all components were identified, but I want to take this funnel case, right? This is the case with the funnels, right? In this situation, it is necessary to determine what is the net book value of the component would currently been initially identified. This will sometimes require initial cost to be determined by referring to the replacement cost and the associate accumulated depreciation charge determined using the rate of used for the vessel. This is like to leave a significant net book value in the component being replaced, which will need to be written off at the end of the replacement capitalize, right? Three things you should learn from this case study. What is the accounting treatment for residual value estimation? There are two scenarios, and you have another scenario to deal with what? Major replacements, right? I discussed one simple question with major replacement in the board and very complex questions from ACCA, right? So with these things, I believe is LK 16 I have covered to a greater extent, right? Fine. So other than this, I want to take some few informations as well, right? Few informations as well means, if you look at your study pack, they have explained another two things, right? Recognition. So when it's come to recognition paragraph, health and safety environment equipment, I want to take this separately from the standard as well, right? So when it's come to standard, they are talking about this under paragraph 11, right? Paragraph 11, initial recognize. When you recognize assets initially, what is the treatment? Read this paragraph 11. I want to explain this separately, right? Fine. This is a new thing, understand. Item of property, plant and equipment, all these things, complex analysis I have explained to you, right? What is initial recognition and subsequent measurements, revaluation, cost model, depreciation, residual value, estimation, and how do you deal with upward and downward depreciation, revaluations, but depreciation you can do it your own, right? When it's come to item of property, plant and equipment may acquired for safety or environmental reason. Safety or environmental reasons, right? Now let's say you need to store some dangerous chemicals, that example is there in standard, right? In a secured place, when you incur cost on that, that cost will not directly give you economic benefits, will not flow to the entity, right? Now let's say this is a very dangerous chemical in my hand, right? So if I keep in this place, someone can use this and that has a significant impact on that person, maybe die, let's say poisons, kind of a thing. But because of safety and environmental reasons, I need to store this in a safe place. So even I keep this asset in this location or safe place, the same economic benefit will flow to the entity. But due to legal and regulatory requirements, I have to store in this in a separate place. If so, what is the accounting treatment? Read this. The acquisition of such property, plant and equipments, although not directly increase future economic benefit, for you to identify assets, you must identify asset recognition criteria. If those criteria are met, only you can capitalize assets. But here, even they are not meeting the asset recognition criteria, right, which is not directly increase in future economic benefits, and particular existing item of property, plant and equipment may be necessary for an entity to obtain future economic benefit from its asset, right? It is necessary, but this storing in a separate place is necessary for you to earn economic benefits. Otherwise, it is not allowable by government regulations to use this asset. If I am using this asset, it should be a separate place. It is necessary to store in a separate place for me to generate economic benefit from this asset. Therefore, such item of property, plant and equipment for recognition as assets, because they are enable entity to derive future economic benefit for related assets in excess of what would be derived had those items not been acquired. Example, a chemical, this example you can highlight. A chemical manufacturer may install new chemical handling process to comply with environmental requirement for the production and storage of dangerous chemicals. Related plant enhancement are recognized as asset because without them entity unable to manufacture and sell them. So whatever the cost incurred for enhancement of that plant or building for you to store in a different location or safe location, you have to identify and capitalize as an asset. Why? Because it is necessary for you to use this asset. However, this result in carrying amount such an asset may be related asset is reviewed for impairment according to LKS 36. It is subject to what? LKS 36 as well. Right? Fine. Understand that as well. Sometimes health and safety related equipments, items, not items, cost which required necessary for you to generate economic benefit, you may capitalize. Right? Why? Directly those costs may not create increased economic benefit, but it is necessary for you to generate economic benefit from that asset. Keep that also in your mind. I want to explain that separately. Then another one you have, which is borrowing cost, right? Borrowing cost. I explained you yesterday, right? So in paragraph 22, right? Paragraph 22 explain LKS 23, right? Borrowing cost established criteria are recognized in the recognition of interest as component of carrying amount of self-constructed item of property, plant and equipment. Borrowing cost means it's a different accounting standard, a separate accounting standard, borrowing cost, which means sometimes let's say for Sri Lanka to build this building, it may require to take a bank loan, right? Borrowings. So then the cost of that borrowing is what? Interest. So can we capitalize that interest on this asset building? Yes, you can capitalize, but it should be what? Qualifying asset. So all these qualifying asset criteria, borrowing cost criteria has explained in LKS 23, which has direct link to LKS 16, but I am not trying to discuss that borrowing cost related property, plant and equipment questions, right? In this, under this LKS 16, why I want to explain this standard little in detail, thereafter we will come back to this and discuss. There is a question, you can have this question references, but we will discuss later on, right? Which is June 2000, ACCA June 2016, question number 3, part A, right? MEs. So this question will be discussed under LKS 23, which is borrowing cost, right? Don't worry, make a note there. When we talked about borrowing cost, we will be discuss this question, right? Fine. So then borrowing cost also, keep this in mind. This is the message I want to tell you. Borrowing cost also you can capitalize. What you can capitalize? Safety and cost incurred on safety concerns, matters, and borrowing cost, the list of initial cost, major replacement cost, major inspection cost, you can capitalize, but not the regular repair and maintenance cost. That's all about LKS 16. Don't expect some simple questions like LKS, like your A-level, O-level, right? Some of you have this understanding, right? LKS 16 is not a big thing. LKS 16 already we have gone through it. From the day we learned accounting, O-level this adjustments was there, A-level each and every year you have these adjustments. Therefore, we know about this standard, but I proved to you very first point when we talked about this LKS 16, you don't know LKS 16. Why? Most of you fail to answer this question. What? The depreciation started date. It should be started from the date of available for use. Which means this is the very first time you are learning the standard with the standard book, right? Before this learning, You had all learnings with your lecturer's tute and your A-level tute, O-level tute, whatever the books you purchase from different bookshops or different institutions. But this is the very first time you are referring LK 16 with the standard book. Therefore, examiner can test not the simple questions like depreciation calculation, but residual value realization questions, borrowing cost related questions, replacement, major inspection related questions can be tested. Sometimes those are not calculations. You have to discuss the scenario, you have to apply your knowledge and explain to the examiner, right. That is the end of LKS 16, and we will start to discuss SLFRS 13, which is a very important standard, next day. Thank you.